All right, folks, let's finish up chapter 1 right quick. And as you remember, we finished with this particular slide here, where we have our assets located here, our liabilities in this column. The only one we had was accounts payable. And over here, we're dealing with equity items. This particular column right here is common stock. That represents what the owner owns. Here we have dividends. Remember, dividends decrease owner's equity, and I'll show you a statement in just a minute that will illustrate that even better. Over here we have revenues and expenses. Revenues are inflows of resources, what our customers have paid us, or those things that we have done and perhaps our customers have not yet paid us, but we're recognizing that revenue. And then expenses in this column, the cost of doing business. So let's pop on forward and look at some financial statements. And as you see, we have income statement. Now, the income statement is dealing with revenues and expenses. That net income from that income statement, that difference between what we brought in and what we paid out, net income, is going to flow into a statement of retained earnings. Retained earnings account represents all the profits that that company has generated since it began, minus any losses, minus any dividends. So we've got a beginning balance in retained earnings, and as you remember, this is a brand new startup business. We're going to add to that net income, subtract from that dividends, and that will give us the ending balance. That ending balance in retained earnings will be captured in the balance sheet. Right, and then finally we'll look at the statement of cash flows. And for businesses, we divide cash flows into being operating, investing, or financing cash flows. And I'll show you an example of that in just a second. All right, so these three main ones: income statement, statement of retained earnings, and balance sheet. As you remember, this company generated revenue by providing consulting services, and they also did rental services. So these guys, are adding resources to the operation. Total of $5,800 of consulting revenue, and we had rental revenue of $300, meaning that we have increased the company by $6,100. Now, everything has a price, and we have expenses to go along with it. We have rent expense. We had to pay for our place. $1,000 outflow of resources for that. We have $700 worth of salary expenses. So we have a total outflow of resources of $1,700. This nets out to be $4,400. That is our net income. Now notice what's happening with that net income. It is flowing into this statement of retained earnings. Retained earnings, just like I said, is all of those profits that we have generated minus any net losses, minus any dividends. So started off with nothing. We have created net income of $4,400. We're going to subtract from that those dividends. Those dividends are an outflow of resources. Cash went from the company to the owner. Cash shrunk by $200, so something has to balance that out, and that is the owner's claim on that cash. So it shrunk by $200. So we end up with ending retained earnings of $4,200. Now that will flow right into our balance sheet, right down here at retained earnings. Remember, we had cash, supplies, and equipment. Those totaled up to $40,400. We have liabilities, total liabilities of $6,200. We add that to the $300 of common stock that just calculated ending balance of retained earnings of $4,200, meaning total equity of $34,200. Sum that and sum that, and we get the $40,400. Notice this balances this, hence the name. Now, another thing I'd like you to notice, this balance sheet, it is for December 31st, 2021, a specific point in time, specific day on the calendar. Notice up here for our income statement and for our statement of retained earnings for the month ended December 31. For the month ended December 31. The income statement and the statement of retained earnings are for a period of time, for a stretch of time. In this case, we're doing these every month. Perhaps we might just do it once a year. If it's once a year, for the year ended December 31st. Balance sheet is on a specific day, close of business, 12 midnight. When we end things, when we shut our books for that particular month, for that particular year. It is a snapshot. This is the financial position of the company at that point in time. And these, the analogy is, they represent a movie, a film, over a stretch of time. Now, we have that ending balance of cash of $4,800. How do we get that? How do we get to that point? Because you remember this company started out with nothing. And this fella started it up. Excuse me. How do we get to that $4,800? Well, that's where the statement of cash flows comes in. Notice we've got cash flows from operating activities. This next category, cash flows from investing activities. And finally, cash flows from financing activities. The financing activities are dealing with that investment by the owners. It may be we issue bonds to help finance our operations. In this case, is a cash investment from the shareholder. And notice it is a positive $30,000. We have cash dividends paid to shareholders. Notice what's going on with these parentheses. That's representing a negative. So the net cash provided by financing activities is this $29,800. Just netting these two guys together. Up here, cash from investing activities. This guy right here, cash paid for equipment. Scroll back up. Notice we've got equipment. We bought equipment and we paid cash for it. It is in parentheses because it is an outflow of cash. We paid the cash for that equipment. So it is netting out, as it would, at negative $26,000. Up here, cash from operating activities. We have cash received from customers. That's what our clients have paid us for the work we've done. $6,100. We also have expenses, negative amount. Cash paid for expenses. And it sums up to $5,100. And we're netting out at $1,000 net cash from operations. When we add all of these up, we get the net change in cash, in this case is positive, of $4,800. Remember, this is a startup. It began on December 31st. We started off with a balance of $0. We end up with a cash balance of $4,800. What we're trying to do in the statement of cash flow is explain this ending balance in cash. We're telling the reader of the financial statements, where did the money come from and where did the money go to? And that's what this statement of cash flows tells us. All right, let's look at a ratio. Return on assets. Now, as you can see on the screen, return on assets is stated in ratio form, percentage, as net income divided by average total assets invested. So, ROI, net income is our numerator, average total assets. And we have some examples here for Nike and Under Armour in the particular years that these slides were made. Current year, Nike has a return on assets of 17.4%. A year prior, 8.4%. 2 years ago, 19%. Something has happened. It was higher, it got lower, and it's coming back. We don't see the cash flow statement in this particular example. We don't see the income statement in this particular example, and we don't see the balance sheet. But if we had pulled those up, maybe we could come to an understanding of why that ROI changed 1 year ago. Under Armour, they had negative return on assets a year ago and 2 years ago. Current year, they are in the positive. Once again, these are ratios we will compare company to company. For our example, remember we had net income of $4,400. And I'm going to pop back to our balance sheet and show you where this $40,400 is coming from. Zoom in. There we go. This right here. This is our total assets on December 31st. And once again, this thing just started up. So I go back to my ratios. So we had ending balance of assets of $40,400. We began the month with 0. Sum those up, divide by 2, and we get $20,200. Divide that into the $4,400 of net income, and we get a return on investment for that month of about 22%. So that is return on investment. Now, why would that be important? If you were thinking about investing in this company, it might be interesting to you to see how well management is utilizing these assets. They're using these assets to generate net income. Businesses are different from our personal operations. There's no need to have an asset if it is not creating income for the organization. If it's not creating income, we should consider getting rid of it. So keep that in mind. We will probably have ratios for each of the chapters that we talk about. All right, until next time, do take care.